A man buys an apartment for what sounds like a ridiculous price. His friends call him reckless. His parents think he's trapped himself in debt for the next 20 years. Every month, money disappears from his bank account like clockwork. EMIs, maintenance brought property tax, repairs, insurance, interest, and yet 10 years later, people look at him like he made a genius move because the apartment is now worth 3 times more. Meanwhile, another person did everything financially smart. No massive loan, no risky property purchase, just consistent investing, Densum funds, stocks, monthly SIPs, quickly compounding in the background. And after the same 10 years, their portfolio quietly crossed the property owner's net worth. No leaking pipes, no registration fees, no tenants calling at midnight because the bathroom ceiling is dripping, no giant loan hanging over their head. 2 people, 2 completely different paths, both convinced they made the smarter choice. And for years, internet has treated this debate like a religion. Real estate is the safest investment. No, stocks outperform everything long term. Property creates real wealth. Stocks are just numbers on a screen. But underneath all the opinions, there's a much stranger reality because most people comparing real estate and stocks aren't actually comparing investments. They're comparing feelings. One feels stable, the other feels uncertain. One you can touch, the other disappears 8% in a single afternoon because some guy at the Federal Reserve cleared his throat during a speech. And that emotional difference changes everything. Because when people say real estate made them rich, they usually ignore the debt. When people say stocks outperform property, they usually ignore leverage. And once you actually run the math properly, answer becomes far more uncomfortable than most people expect. Because the real question isn't, which investment gives higher returns? The real question is, which one changes human behavior in a way that quietly creates wealth? And those are not always the same thing. Right now, this question matters more than ever, because we're living through one of the strangest financial environments in modern history. Property prices exploded, stock markets exploded, interest rates exploded, then affordability collapsed. Entire generations are now stuck between 2 terrifying choices: take on massive debt to buy property, or stay liquid and invest while watching house prices run away from them. And everywhere you look, people are trying to justify whichever decision they already made. Homeowners say renters are wasting money. Investors say homeowners bought emotional liabilities. Everyone wants validation. Very few want the math. So let's actually do the math, not the social media version. The real version, the one that includes leverage, taxes, inflation, opportunity cost, human psychology, and the hidden reason why 2 people can get the exact same return end up with completely different financial lives. Because this debate isn't really about property or stocks. It's about how humans react to uncertainty. And uncertainty is where most wealth decisions quietly fall apart. Let's start with the fantasy version of real estate. The version most people carry in their head. You buy a house, its value slowly rises over time. You live in it, maybe rent it out later. Eventually, it becomes worth a fortune. Safe, predictable. At least, that's the story. But the actual mechanics are much weirder, because real estate has one giant advantage that almost no other ordinary investment has. Banks are willing to hand you enormous amounts of money to buy it. And that changes the entire equation. Imagine 2 people each have 10 lakh rupees. One invests in stocks. The other uses it as a down payment on a 1 crore property. Immediately, property buyer controls a much larger asset. That's leverage. And leverage is the hidden engine behind most real estate wealth stories. If that 1 crore property rises by just 10%, the property gains 10 lakh in value, which means the buyer technically doubled their original investment. On paper, that sounds incredible. And honestly, sometimes it is. But leverage has a dark side nobody talks about during dinner conversations. Debt magnifies outcomes, not just gains. If the property falls 10%, the equity can get crushed surprisingly fast. And unlike stocks, real estate losses move slowly, quickly, almost politely, until suddenly they don't. The scary part about property bubbles is that they often feel safest right before they break. Because prices don't update every second like stock markets. Homes don't flash red candles on your phone. Nobody gets notifications saying, "Your apartment dropped 4.7% today." So people assume stability. But often, that stability is just delayed price discovery. In stocks, panic is immediate. In real estate, panic takes months, sometimes years. And yet, people still trust property more. Why? Because human beings confuse visibility with safety. A house feels real. You can walk inside it, touch the walls, open the windows, show it to relatives. Meanwhile, stocks feel abstract, digital, invisible, almost imaginary, which is ironic because the companies inside stock indexes are often producing real products, real cash flow, and real profits every single day. But psychologically, humans trust what they can physically see, even when the math says otherwise. Now here's where things get uncomfortable. Historically, stocks have often outperformed real estate over long periods, not by a tiny margin either, especially when dividends are reinvested, because businesses can scale infinitely in ways physical property cannot. A company can suddenly serve millions of new customers globally. An apartment cannot suddenly become 10 apartments. Real estate is constrained by physical reality. Businesses are constrained mostly by execution. And this is why equity ownership became one of the greatest wealth creation mechanisms ever invented. You're not just buying assets, you're buying productivity, innovation, expansion, human ambition itself. When you own stocks, you own pieces of systems designed to grow. And over decades, that growth compounds in ways the human brain struggles to intuitively understand. Compounding is strange because it feels slow, until suddenly it feels unfair. In year 1, nothing happens. In year 5, still unimpressive. In year 10, interesting. In year 20, confusing. By year 30, people assume you got lucky. Because exponential growth never emotionally feels exponential while it's happening. And that's one reason many people abandon stocks too early. The journey feels underwhelming compared to property. Property gives visible progress, a building, a possession, a milestone. Stocks just give statements, numbers, percentages, no social status. Nobody's relatives visit during festivals and say, "Wow, beautiful index fund allocation." But they absolutely will admire a house. Which reveals another hidden truth. Real estate is partly an investment, but it's also consumption, lifestyle identity, social proof. And mixing investment with identity changes decision-making dramatically. People become emotionally attached to property in ways they rarely do with stocks. They refuse to sell bad properties, overpay because of prestige, buy oversized homes to signal success, take massive loans because everyone around them says prices only go up. And when identity enters investing, math often leaves the room. But stocks aren't innocent either, because stock investors love pretending they're rational. They're not. Most people say they believe in long-term investing until markets fall 30%. Then suddenly everyone becomes an economist. Now inflation matters. Now geopolitics matters. Now valuations matter. And people who proudly called themselves long-term investors 2 months earlier start panic selling diversified index funds because CNBC used the word uncertainty 17 times in 1 week. Stocks expose human psychology brutally fast. That's the real reason they outperform many investors. Not because markets are unbeatable, but because human emotions are. The average investor often dramatically underperforms the investments they own. Not because the assets failed, because behavior failed. Buy high, sell low, repeat. Ironically, real estate accidentally protects people from themselves. Selling a house is difficult, slow, expensive, emotionally exhausting, which means property owners are forced into long holding periods. And long holding periods quietly solve many investing mistakes. A stock investor can destroy years of returns in one emotional week. A homeowner usually can't. The friction saves them, which creates one of the strangest truths in finance. An investment with lower theoretical returns can still create more real-world wealth if it produces better human behavior. And this is where the debate becomes dangerous. Because once you include human psychology, there is no universal answer anymore. Some people genuinely build enormous wealth through real estate, not because property mathematically dominates stocks, but because property forces discipline. Monthly EMIs become mandatory investing, leverage amplifies gains, time does the rest. Meanwhile, someone else keeps waiting for the perfect time to invest in stocks and never starts. But there's another layer people rarely discuss: liquidity. And liquidity changes everything during emergencies. Imagine you suddenly need money. A large medical expense, job loss, business collapse. A stock portfolio can usually be accessed quickly. A property cannot. You can't sell your kitchen. You can't liquidate half a balcony. Real estate wealth is often extremely concentrated and painfully illiquid, which creates an illusion of richness. Some people are technically crore-patis on paper, while simultaneously struggling with monthly cash flow. Their wealth exists mostly inside walls, and this becomes especially dangerous during economic downturns. Because property markets freeze psychologically, buyers disappear. Transactions slow. Everyone waits. Meanwhile, EMIs continue arriving with terrifying consistency. Debt never cares about market sentiment. Banks do not pause because housing demand weakened. And suddenly, the safe investment starts feeling very unsafe. This happened repeatedly across history. In America during 2008, in Japan after the 1980s bubble. In parts of China more recently, entire societies became convinced property prices could only rise, until eventually affordability broke. And when affordability breaks, system becomes fragile. Because housing markets don't just depend on demand, they depend on financing. People don't buy homes with cash. They buy monthly payments. That's why interest rates matter so much. A small change in rates can completely change affordability. A house price may stay the same while the monthly EMI becomes impossible. And once financing weakens, illusion starts cracking. This is why real estate cycles often move slowly, then suddenly violently. But here's the part most online debates completely ignore. Primary homes are not purely investments. They're risk management tools. That distinction matters enormously. Owning the home you live in provides emotional stability, predictability, control over your environment, protection from rising rents. And those benefits are real. Not easily measurable, but real. A spreadsheet cannot fully quantify the psychological relief of knowing nobody can suddenly ask you to vacate in 30 days, which means some financial decisions should not be judged purely by return percentages, because humans do not live inside Excel sheets. At the same time, calling every home purchase an investment can also become financially delusional, especially when people stretch beyond their means chasing status. A luxury apartment bought mainly to impress others is often not an investment. It's consumption disguised as investing. And modern society encourages this confusion constantly. Developers market aspiration, not yield, not cash flow, not opportunity cost. Aspiration, the advertisements are never about maintenance costs, or vacancy risk, or poor rental yields. They're cinematic lifestyle fantasies, sunlight balconies, slow-motion coffee pouring, a couple laughing for no reason while looking at city skylines. Nobody in those ads is calculating annualized returns after maintenance and taxes. Meanwhile, stock investing has the opposite branding problem. It's visually boring. No marble flooring. No dramatic keys handed over. No family photos outside buildings. Just charts. And because humans emotionally respond to stories more than spreadsheets, real estate often feels more successful than it actually is. Now let's talk about something even stranger. Inflation, because inflation quietly changes how both investments behave. Property often performs well during inflationary periods because replacement costs rise, land becomes scarcer, construction becomes more expensive, rents rise. Debt also becomes easier to repay in real terms over time if incomes increase. Inflation can quietly benefit borrowers, which partly explains why leveraged property ownership historically created so much wealth. Meanwhile, stocks respond differently. Businesses with pricing power can raise prices and maintain profits. Weak businesses struggle, which means stock investing is partly a bet on economic adaptability. Property is often a bet on scarcity. Stocks are often a bet on productivity. And those are fundamentally different engines of wealth creation. Scarcity says, there's limited land. Productivity says, we can create more value. Historically, productivity tends to create more long-term growth for societies. But scarcity can create enormous wealth locally, especially in rapidly urbanizing cities. That's why location matters so much in real estate. Two apartments separated by a few kilometers can have completely different outcomes over 20 years. Meanwhile, broad stock indexes spread risk across hundreds of businesses automatically, which reduces dependence on one geographic outcome. But diversification introduces another psychological problem. Diversification feels less exciting. Human beings secretly love concentrated bets. We love the fantasy of one decision changing everything. One property, one stock, one big move. But sustainable wealth usually comes from surviving long enough for compounding to work. And survival is often boring. Which brings us to one of the biggest misconceptions in finance. People obsess over returns, but wealth destruction usually comes from fragility. Too much debt, too little liquidity, overconcentration. Emotional decisions during stress, one catastrophic mistake, can erase decades of compounding. And both stocks and real estate can become dangerous when people overestimate certainty. The stock investor assumes markets always recover quickly. The property investor assumes prices never stagnate. History says both assumptions eventually get punished somewhere. Japan's real estate market took decades to recover after its bubble burst. The American stock market went through brutal, lost decades too. There are long stretches in history where neither asset class feels magical, which is deeply uncomfortable because modern financial culture constantly sells certainty. Buy this, invest here, this always wins. But reality is messier. Financial success often depends less on choosing the perfect asset and more on avoiding catastrophic behavior. And ironically, that brings us back to the beginning, because the real estate versus stocks debate is often framed like a math competition. But in reality, it's partly a behavior competition. The best investment is often the one you can consistently hold without psychologically imploding. Some people genuinely cannot tolerate stock volatility. They panic, obsessively check prices, lose sleep, sell during crashes. For them, property's slower movement may actually produce better long-term outcomes, not because property is objectively superior, because their behavior becomes superior. Meanwhile, other people hate debt, hate illiquidity, hate being tied to one giant asset. For them, stocks create freedom, flexibility, mobility. And those psychological advantages matter too. Because investing is never purely mathematical. It's emotional time travel. You are constantly making decisions today based on who you think you'll become years from now. And humans are spectacularly bad at predicting their future emotions. A person who confidently says, "I'll stay calm during crashes," often discovers they were lying to themselves. A person who says, "I'm comfortable with huge debt," sometimes realizes they aren't once layoffs begin spreading. Financial strategies always look smartest before reality arrives. And reality has a habit of testing assumptions at the worst possible moment. That's why the richest investors often focus obsessively on resilience, not maximum returns. Resilience, the ability to survive mistakes. survive volatility, survive uncertainty, because surviving long enough is what allows compounding to eventually look magical. And maybe that's the most misunderstood part of wealth creation. People think becoming rich is mostly about intelligence. Often, it's about endurance. The endurance to keep investing during boring years. The endurance to avoid panic during crashes. The endurance to ignore social pressure. The endurance to continue compounding while everyone else keeps chasing shortcuts. And this is where both real estate and stocks reveal something uncomfortable about modern life. Neither investment actually guarantees wealth anymore. Not in the way older generations experienced it. In many cities, housing affordability has detached from incomes completely. In markets, valuations sometimes feel disconnected from reality. Young people look at both options and feel trapped. Property feels unreachable. Stocks feel uncertain. Savings lose purchasing power. And slowly, an entire generation begins feeling like the financial system itself is moving faster than they are. Which explains why these debates online become so emotional. People aren't just defending investments. They're defending hope. Hope that their chosen path still leads somewhere stable. Hope that they're not already too late. Hope that the rules still make sense. But maybe the most important realization is this. Real wealth was never created by choosing one perfect asset. It was usually created by owning productive things consistently over very long periods of time, while avoiding self-destruction. Sometimes that productive thing was businesses, sometimes land, sometimes both. The exact mix mattered less than discipline, survival, and time. And maybe that's why the real answer to real estate versus stocks feels so unsatisfying. Because the honest answer is, the better investment often depends less on markets and more on the investor, their behavior, their temperament, their debt tolerance, their time horizon, their need for liquidity, their ability to survive uncertainty without making catastrophic decisions. But there's still one final irony hiding underneath all of this. The people who become truly wealthy over decades often stop obsessing over which asset class is superior, because eventually, wealthy people tend to own both businesses, stocks, property, cash flow, land, different assets solving different problems simultaneously. Which means the loudest debates usually happen among people still searching for certainty, while the people furthest ahead quietly focus on resilience and ownership itself. And maybe that's the strangest part of all. For decades, people argued over whether real estate or stocks create more wealth, while inflation quietly punished everyone who owned neither. And somewhere in the future, another generation will probably repeat the exact same debate. Different prices, different cities, different tickers. Same emotions, same fear of missing out, same desperate search for the correct decision. Because underneath every investment debate, there's usually a much deeper human question hiding in plain sight. What if I choose wrong? And that fear, more than stocks or real estate, has probably destroyed more wealth than either market ever could.